Hi, everyone, and welcome. We're excited to see everybody here today, and thrilled to host our first in-person Evolving E since 2019 with this distinguished group. And I think you all recognize we've got some amazing thought leaders here today from the consumer internet and fintech space, all from investors to CEOs and thought leaders. And despite the challenging times, it's exciting to see industry leaders like yourself come together to share your insights and perspectives, and I think to truly collaborate. And I think that's one of the things that makes the GGV events unique, because they love to talk about this scaling and bring others along with them. And I think it's a fantastic opportunity to recognize them within the VC community in doing that. And to really recognize that we're evolving. I think Robin talked a little bit about changing the format. And I think that's important, the pivoting as you're going along as an entrepreneur and recognizing kind of where we are in the marketplace, which we'll talk a little bit about in a minute. I hope that you all really get to recognize that this is a very sort of transparent, open environment, supportive and engaging, and really meant for you all to get an opportunity to network. So we welcome your questions and engagement today. Hans, I'd also like to thank you and congratulate you and Robin and the rest of the GGV team on putting together this fabulous event. We look forward to supporting you and the rest of the GGV community and ecosystem as you digitize the economy. And with that, I'd like to welcome our special guest and you all to listen to our fireside chat. And we're going to focus on the economy, the current state of the market, as well as the IPO market when that might open. We have a lot of opinions about that. So with that, I'd just like to welcome, and I hope my mic works here, Achintya. Yes, thank you so much. So Achintya is Global Head of Capital Markets at JP Morgan. He was co-head until 3 weeks ago. So he's now global head and based in London, moving to New York to take on his new responsibilities.
Thank you.
So why don't you tell us a little bit about yourself, your background?
Sure.
And
no, thank you, Karen. First of all, Hans, Robin, and the GGV team, on behalf of JP Morgan, well, thank you for having us here. We appreciate the partnership, and as Karen said, looking forward to years more of growth and cooperation. And Karen, Nasdaq has always been an amazing partner, so looking forward to doing more. But by way of introduction, this is kind of, I'm really excited to come to New York, come to the US, but I grew up in India, studied there, was an engineer, don't really know much about engineering anymore, but nevertheless. My career actually started in Hong Kong. So I was in Hong Kong in 2000, spent 13 amazing years. Best part of my years, in fact. My children were born there, and that's why I have views on China which are much more positive than my boss Jamie and Daniel and Carlos. But I often say, unless you live in the region, you can't really absorb it. But I had a great time. 10 years ago, I moved to the UK, and I've been in London there. I've run the capital markets business in Europe as well. And now I'm looking forward to moving to the US. I don't know much about the country or the business or the people, but that's part of the excitement. I'm here to learn and hopefully learn from people like you and work with you all. So very exciting times.
Great. And for those of you I haven't met, I'll just give you a little bit of my background. So I run US listings here at Nasdaq, and that includes all the support that we provide to private companies, as well as companies once they go public. On the private side, we provide visibility support. So if you're doing a financing, we can run a tower shot for you, and we do a lot around governance. So as you think about preparing to go public, we're happy to discuss that with you further. And then we do a lot around secondaries, creating liquidity as you think about potentially bringing in additional shareholders, creating liquidity for your employees, and that type of thing. So why don't we start by talking a little bit about where we are in terms of the economy, and what really kind of transpired over the past year and a half and how we got there.
Sure. No, Karen, I'm very happy to. Look, I think the last 2 years, if I may start with, I think to me it's really two different things that have led us to where we are. One is obviously the tragedy that the whole world has lived through, COVID, and I think almost everyone has suffered. But the one aspect of the tragedy which is unmistakable, I think, is the acceleration that it caused in digitalization. I think whether it's consumers like us, as a personal example, my wife would never order groceries online, no matter what, before COVID. But after COVID, I think we have accepted it's a small example, but I think COVID has forced acceleration of digitalization, both on the consumer side, as well as the company side, the way companies consume or interact with consumers. And I think that is a trend which is, it's not going to change. I think it's going to keep going, and it's going to be more global than ever. And I think, necessity is the mother of all invention. Because of the way the world had to go through, it happened at a pace which is much, much faster than any other organic way. Companies were forced to invest in digitalization. And I think that's where a lot of growth happened in e-commerce. That's where a lot of growth has happened in fintech, and that growth will continue. But that was a big vertical of what has happened. And I think that's the exciting, more stable part of it, which will continue. The other part is probably resulting in a few problems here, which is free money. I think the amount of liquidity and the reaction that central banks globally had to do to provide money, I think had two consequences. One is, you could argue more rational and more logical at the time, which is valuations. When you have free money, you can discount future cash flows and kind of ignore the need for profitability in the next 3 years. You can ask for it in 6 years' time, in 7 years' time, and you're still going to have a very profitable model. But the problem is, once profitability is so much out in the distant future, it becomes a theoretical and a conceptual point, and everyone is not focused on the proof point of profitability. You're just focused on the concept of profitability, and market share replace that. And I think valuations skyrocketed. Much of it is mathematical. You replace current interest rates with zero interest rates, and your valuation should be up 30% just mathematically, if not more. And I think that has been a challenge, and it'll be, I'm sure a lot of you are facing that challenge. Some of the challenges are as simple as employee retention. A lot of companies we are speaking to are thinking of resetting employee stock options over the last 2 years, funding. And of course, I think the focus on investing in business models which have growth, but there needs to be now a more proven path and a more short-term path to profitability. And I think that is part of what we'll talk about, which is not sustainable. Not every company will survive. Not every sector or subsector will grow as much. And the second, I think, is allocation of capital. I think, again, the amount of capital that was available meant that almost every quality and every subsector of growth in tech attracted capital, flying cars included. And not just one, but many of them.
I've been ordering for one.
There you go. I would love to. In London and Europe, they kept talking about these flying helicopters that'll get you from Heathrow to the city. Just one too many.
Yeah.
But that might be an opportunity. So I think, to me, the question is going to be, now where we are is the digitalization and adoption of technology is irreversible. And I think that's great for mankind. That's great for humankind. I think it's fantastic. But rates are not going to go back to zero, not anytime soon. So valuations, people have to accept the new reality. And I think people will accept the new reality on valuations. And two is, business models have to change. And the capital will go to those companies who have a growth model, but a more sustainable, profitable model. But capital will be allocated more smartly. So in some parts, it sounds very challenging, but I actually think the tech world will continue to be growing, and at a much more global level than ever before.
Yeah, I think that's very well put. So let's talk a little bit about the outlook.
Yeah.
And what we think 23 and 24 will look like.
Sure. When we talk about outlook, Karen, I have different views on different parts of the world. So I think we got to kind of separate it. The US, look, I'm new to it. I'm still learning. But I actually think the US is in the strongest position globally ever. Sure, we may have a recession. But I think we all get carried away a little bit by technology terms like recession. What is a recession? A recession is, a reduction in GDP quarter on quarter, year on year. So be it. It's okay if there is a recession, in my view, but I think the fundamental strength of the US economy is strong. So there might be a period of a slow growth, there might be recession, but I think coming out of it, you can't take away the fundamental strength of earnings that are coming up. Mm-hmm. The world in the US is more profitable than it's ever been. Cash levels in terms of cash to assets for American corporates are actually almost, not all-time high, but very close to all-time highs. So I'm very, very positive on the US. Sure, we'll have volatility like we're having now. Maybe it exists for another 2 months. Maybe the S&P and Nasdaq go down another 10%, or 15%. But I don't think that takes away from the fundamental strength of the economy and the private company formation. Europe and the UK, I fear, have a very different path. I don't know what the path exit is there. I think Europe and the UK, I think the fundamental problem of energy dependence from Russia has been completely miscalculated. Like Germany, on the back of the Japanese nuclear accident, shut down all their nuclear plants many years ago. And 40% of their energy comes from Russia. And I don't know how those countries will have the ability to sustain high energy prices. I think if you look at global talent, the US is still where the best global talent, the best capital comes to. I think so Europe and UK, and if you combine that with the geopolitical things, if you look at Italy, the far-right government, if you look at France, if you look at the UK politics, I think that's a struggle. So I worry about that. I think LATAM, I'm super excited. Again, don't know what the Brazilian elections mean, but in general, are we positive about LATAM in general and tech? Absolutely. So then it's Asia. I think in Asia, you can blame it on my 13 years in Hong Kong, but I'm personally very positive. I think China is, sure, it's a mammoth country, sure, it can't grow at 10%, but I think at some point this next year, they will open up, the economy will grow, and again, the underlying private company formation there, and they've done a great job of moving from hardware to also intelligent software, to AI, to data. So I'm very positive on China in the medium term. Mm-hmm. Now, the geopolitical aspects, I'm not commenting on them. I'm simply commenting on the fundamental side of the economy. But I think China will do well. I think India is probably the last leg of tech growth. The US tech happened, China tech happened, LATAM tech happened. If you look at India, the demographics of India are not very different from China and LATAM in terms of what the impact could be on tech. And India has always been driven by software. So if you look at internet and e-commerce and fintech, this is their time. Mm-hmm. So I feel positive about Asia. I think Japan is a bit tough. But I feel positive about Asia, positive about the US and LATAM. Europe is where I have question marks on.
Mm-hmm. Yeah, and I would say, in terms of the IPO market, Mobileye happened last week. I don't know if everyone paid attention to that, but that was, really the first sizable deal that we've seen in a while. And if you were paying attention to that, and the valuation got walked down a lot, but it traded really well, and I think that was really important in terms of starting to open up the IPO market. I wouldn't say that it's open necessarily, but what I would say is that we're optimistic that we'll start to see some bigger names, marquee names come to market, and that'll start to unfreeze things a little bit. And I think what you touched on is important. That the market has traded down 25%. The Nasdaq composite, which is tech heavy, is down 30%. What's good about that is, I'm not calling the bottom, but it's feeling like things have shaken out a lot. And Q3 earnings are really starting to come through, not in the best way, but in a way that I think will make the Fed understand the rate increases have had some impacts. And investors and companies are starting to re-rate their earnings. And that's really, really important to start to feel like things are getting washed out and bottomed.
I think if I make Karen, on the technology side, it's not a bad thing if there is a bit of a slowdown. ECM, if there's a bit of a slowdown on IPOs, there were like 120, 140 IPOs. I think this is actually a time where the companies could use to change their business models a little bit, shift and reallocate capital to more profitable areas. That's why you're seeing more carve-outs like Mobileye. You saw Porsche spin out of Volkswagen, which was, again, not a market opener, but nevertheless a unique asset. So I actually think the growth in tech companies is actually you will come out of this cycle with more sustainable, more long-term, more solid companies. And probably the last thing I would say is that, we talked a little bit about reallocation of capital. Agri-tech, that's probably an area which didn't get a lot of capital before compared to flying cars, for example, which is my favorite, but we'll get more. If you look at, impact tech, climate tech, there are, labs which are doing fusion in a backyard in Oxford. They're getting more money now. And I think some of these reallocation of capital will actually be much better for the overall technology landscape in the medium term.
Yeah, we were talking earlier, we both started on Wall Street about the same time in the internet bubble, and time to watch it pop.
But actually on that point, I do think that the path from, talking about the internet bubble, the path from going to just eyeballs in 2000 to revenues and growth, it took much longer. I think the path from now, which is growth and revenues to profitable growth, will be much, much shorter, much more compressed. And I think that's the good news about where we are today. And I would say it's also more global. Like in Europe, finally we are seeing the virtuous cycle of new companies and entrepreneurs becoming seed investors. Hans, you mentioned you guys are right through the life cycle. We haven't seen that much outside the US. So I think globally, to me, tech is actually in almost a much more interesting phase now where expectations are realistic, more sustainable, capital will be employed more smartly, and that will result in better, stronger companies.
Yeah. So we are going to take questions, so just start to think about them as if you want to ask. But before we do that, I think it might be helpful to share some advice that you give to entrepreneurs as they're thinking about preparing to go public. What are some of the best practices as well as some of the pitfalls that you've seen?
Look, I think the first thing we say is we can advise from a distance, but at the end of the day, the one thing I would say has always been true is don't try and change the positioning or what the company does to adapt to what the market wants. I think you've got to stay true to what your business model is. What is it that you want to achieve? And I think that stays more true now than ever. But I think how do you use the current times? I think the first is, again, get a business model which is more adapt to current market conditions, which will exist, which is sure, grow, but unit economics and profitability, I think there is just no substitute to that focus. I think three is, one of the things we witnessed is a lot of companies, some of the companies went public without having the proper management teams and financial systems in place, which really struggle after IPO. And all of you probably know this, so I'm stating the obvious, but once you're listed, it's not so much the absolute results that matter. It's actually a lot of it is versus expectations. You can have amazing results, but if the market is expecting 40% growth and 30% profitability and you turn up at 25, it doesn't help. And I think having that sound management team and having that balance of promising high growth, high profitability at IPO to get the right valuation versus beating and matching and beating and matching, I think that's just something which, to me, this market is a great time to reboot the talent, to reboot the business development plans, to have systems in place, to invest in the right areas, and not rush. Because the market, look, I think the other benefit, Karen, is, and you're doing a lot of time, Nasdaq, private capital markets, private capital is still plenty. Sure, it's more expensive. It's probably more structured. Both Nasdaq and I think JP Morgan, we're doing a lot in the private capital market space. I think issuers should use their time to stay public. There is no rush. Do go public when you need to. And I think hopefully between yourselves and us and others in the market space, there'll be more liquidity options, more options for everyone, employees, investors, and companies in the private space.
Yeah. So I would say I agree 100% with your advice on really under-promise and over-deliver. In the 20 years of taking companies public that I've seen, It's really hard when you misstep to get investors to come back to your story. And we call those abandoned stocks.
Yeah.
And they stay abandoned for 5 years and over, because once you burn somebody, they just dismiss it, and it takes a lot for them to come back. So that's really important, and really sort of looking around, looking at your management team and looking at them from the perspective of their past experience, their skill sets, what are they bringing to the table, as well as your board, right? A lot of times companies ask, when's the right time to start thinking about independent directors. We've really started to see private equity companies bring in independent directors a year or two ahead of going public, and we're starting to see it more in the VC community as well. These are people that you are going to end up reporting to. So to the extent that you can choose them early, and when they can really add value to your business model, I think is really important to think about. So with that, we have about 3 minutes left. So I'd like to open it up to anyone who might have questions. None? No? Go ahead.
Hi, thank you so much for the interventions. It's Ralph from founder and CEO of Joker, one of the proud GGV portfolio companies. What are the signs of economic recovery that you're monitoring? And how do you assess economic recovery, that it happens or that it doesn't happen?
I think if you look at the US, for example, I think consumer spending is obviously one that we are monitoring. Two is, I think, the corporate profits. I think that, to me, is ultimately the real foundation for the relatively optimistic view that we have of North America in particular, where corporate profits are actually quite strong on a relative basis. And leverage is not a big concern, at least in the US. So if you look at the UK and Europe, leverage is a concern. So as interest rates go up, if leverage is not a big concern, combined with good, reasonable profits, I think that gives us a lot of sound. Sure, they'll have bad quarters and results will be a little bit poor, but as you said, the Q3 results and everything else, that's really what is giving us a bit of confidence.
Thank you.
Yeah, and this is a little bit, when we think about other crises we've gone through, this is 100% self-inflicted. So, and I think we're all a little bit nervous that the Fed get it right. But it's actually a positive thing that the corporate balance sheets and personal balance sheets are in really good shape. There's not sort of that underlying, mortgage crisis or, things that we've seen in the past. That doesn't mean that you can't have this exogenous shock, and raising rates the way that they've been raised. It's gonna hurt, I think, emerging markets and other markets more than the U.S. That is, I think, an underlying concern overall is can that bring the U.S. down? But ultimately, I would have to say I agree that the U.S. is probably one of the better places to be investing, and I think global investors recognize that at this point.
Indeed.
Anything else? Great. Well, we do have a bunch of Nasdaq people floating around. If you want to raise your hands, Maddie, Christina, Sahar, I think we have Ivana in the back there as well. So feel free to grab anybody at any time if you'd like to speak. And I don't know if
we have
you have
Lucy
your
here
colleagues
from JP Morgan San Francisco office. And there she is. But no, otherwise, look, thank you again to Hans, Robin. Thank you to Nasdaq.
Yes,
thank you. And pleasure to meet you all.
All right. Enjoy the day.
Enjoy yourself. Thank you.
Great. Thank you so much, Achintya and Karen, for that slightly more optimistic take. It's refreshing to hear the optimism, just given the gloominess of the market environment these days. But I think, what Achintya was saying on proof points of profitability, sound management teams pre-IPO, this is something that we're advising a lot of our portfolio companies to focus on as well. And it's something that we'll be discussing more later.